Good day, everyone, and welcome to today's SOFTRAX Executive Webcast conference call. Today's call is being recorded. At this time, all participants are in a listen-only mode until the end of the presentation. At that time, you will be instructed on how to ask a question. And at this time, I would like to turn the call over to Bob O'Connor, the President and CEO of SOFTRAX Corporation. Please go ahead, sir.
Well, thank you very much, and welcome everyone to today's webcast. As you know, I think SOFTRAX is a leading provider of revenue management solutions to hundreds of companies, many of whom join us on the webcast today. We have well over 1,000 registrants for today's webcast, which indicates how much executives want to hear about today's topic from our distinguished speaker, Dr. Tony Sondhi, who is backed by popular demand to make his presentation entitled The New Standard, International Financial Reporting Standards, which we're referring to IFRS throughout the presentation, and revenue recognition. And Tony will make himself available for questions at the conclusion of his prepared remarks. Let me just take you quickly through our agenda. I'm going to spend a few minutes talking about SOFTRAX and how we fit into today's topic, and then I'll turn the time over to Tony, who will, for the majority of our hour together, focus on his comments about IFRS and the issues. And there's a lot here, folks, and Tony's hopeful to get through it in 40 minutes, and it's possible that we may come back for more topics on this as well. But Tony's promised us 40 minutes on this, and we'll leave 10 minutes for questions. For those of you who are unfamiliar with our webcast format, we do leave again about 10 minutes for you to ask questions of Tony at the end of the webcast, and again, all of this will be done by the top of the hour. And to ask questions, please look at your console, and you'll see the Ask a Question feature. Please click on that anytime you want during the webcast. I will be reading every question for Tony during his presentation, and I'll be asking them again at the conclusion of his prepared remarks. And the most commonly asked question is, can I get a copy of the slides? And the answer is yes, but we do make you work a little for those. At the end of the webcast, and you have to make sure that your pop-up blockers don't block this, you will get a URL to go to a short online survey. We listen to those, and today's topic is a direct result of people wanting to hear from Tony about international issues and revenue recognition. And by virtue of you filling out that questionnaire, you'll be able to get a copy of the slides. You'll get a link with an online recording, and you'll also be eligible for 1 CPE credit. And again, you have to finish that questionnaire, and in order to get the CPE credit. And on top of that, if that wasn't enough, 10 lucky attendees will get a free copy of the 2008 Revenue Recognition Guide, which Tony is the author of. I heard Tony these will be autographed. I don't know if that's true, but if that's the case, their value has just gone up dramatically. So let me spend a few minutes after that housekeeping on how we fit into this topic. SOFTRAX develops enterprise software that manages all aspects of a company's revenue cycle. And throughout the U.S. and throughout the world, hundreds of companies from many different industries use our software to manage their complex billing, revenue recognition, reporting, and forecasting. And as you may know, SOFTRAX started by serving the complex needs of the software industry, and we are the clear leader in that market. And as you can see from the slide, we have grown to address managing the revenue needs of many other industries. From a Sarbanes-Oxley perspective and internal controls, the question was asked by RevenueRecognition.com and IDC, what are the most difficult areas to establish effective internal controls? And not surprisingly, it was found by the study that those areas that are most difficult to establish internal controls are around revenue-related processes, and they remain the hardest areas, including contract management, those areas that deal with spreadsheets and revenue recognition, and those are the areas that our company focuses on to help our customers. And speaking of spreadsheets and revenue recognition, in another study by the same sources, it was found that most companies are still using spreadsheets to manage these critical revenue recognition processes, and this is the source of many material weaknesses and approaches that don't scale, and remains problematic for many people who continue to do that. And in another study, it was found that 57% of companies are not finalizing their revenue numbers within their standard monthly close process. And the delay is caused by the increasing complexity of their transactions and the fact that required information is not available in time during that monthly close process. And all of these studies, you should note, and more, and all these studies in greater detail, are available on revenuerecognition.com, and we encourage you to visit there to participate in these studies and to learn more about these studies. So now let's take a look at the operating and accounting challenges that CFOs and their staffs are focused on at this point. On the left side of the screen, that we see that they have operational challenges related to business models, including contracts and subscriptions and maintenance renewals, and many people certainly on a transaction or hosted or on-demand model makes for greater operational transactional issues to deal with. At the same time, they need to comply with revenue recognition and Sarbanes-Oxley's issues. And in addition, they're under great pressure to provide financial reporting, greater visibility, and shorter close cycles. However, more likely, in many companies that we meet, we see companies trying to address these challenges with a host of disconnected and manual systems that create roadblocks, even daily roadblocks, to operational efficiency and accuracy. And some of the business implications of this approach are listed here, including those that affect cash flow, profitability, operating efficiency, and overall company performance. And our applications are closely aligned to the previously mentioned challenges that the financial organizations face. We have billing and operational applications focused on areas such as contract management and complex billing and renewals, deep revenue recognition capability. If you look at the middle of the slide, you see a lot of issues around VSOE and revenue allocation and percent complete and other revenue recognition guidelines. And analytical applications on the right that are needed to improve the visibility and help executives make strategic decisions. And all of these applications can be licensed individually or together, and they are packaged in two major offerings. The first is a complete billing and revenue management solution by industry, depending upon the industry, whether it's software or software as a service or BPO or information providers. And secondly, for those companies who have invested in SAP, Oracle, or Microsoft or another large enterprise or ERP applications, our application sits in the middle of these applications, being able to handle revenue allocation, scheduling, forecasting for booked business or forecasted business. And this application is highly configurable through our technology for many different industries as well. So our mission is to help our companies and our customers realize the following benefits from an operational perspective and compliance perspective, help them increase their revenue, reduce their operating costs, all the while complying in today's environment. So let me spend a moment introducing Tony Sondhi. For those of you who don't know him, he does a lot of work with our company and many of our customers as well. He is currently a member of the Emerging Issues Task Force, the EITF, of the Financial Accounting Standards Board, FASB. And I could spend all day on his resume, so I won't, but he's also the co-author of the 2006 to 2008 Revenue Recognition Guides and also the Analysis and Use of Financial Statements, the third edition. He serves on the board of directors of an investment advisory firm and also is an advisor to many U.S. and foreign companies. And Tony has joined us on these webcasts before. It's always great to have you, Tony, and the floor is yours, sir.
Thank you very much, Bob. As always, it's very good to be here and to work with you again. The topic that we've selected today is certainly critical. It's obviously off the moment. It's something that everybody wants to know something about. And as Bob pointed out, we're probably going to spend far more than just this one webcast talking about this because it's necessary in order to make some sense out of all the issues involved. So let me begin by saying that today's session will be really an introductory one. I just want to sort of set the stage for the kinds of things that all of us who are involved in these issues need to think about. So first let me begin, of course, by saying that there's long been a debate in the marketplace, if you wish, about whether we ought to have more than one set of accounting standards worldwide. And I won't go into the pros and cons of that. Suffice to say that many people agree or feel that it would make a lot of sense to have a single set of accounting standards so that you could understand financial statements that were prepared in different places so that you could actually use that information and make more informed, better choices for investment decisions. So from that perspective, most people agree that it would be a good thing to have a common set of accounting standards. Now, of course, as everybody knows, we in the U.S. have had accounting standards for quite some time, and if you look at the way the rest of the world has been doing this, you'll see there are pockets, for example, the UK, where there are some very significant and carefully developed accounting standards. There are other countries that have their own standards as well. Now, at the same time, starting sometime around the 1970s, there was developed international accounting standards. And the international accounting standards, if you think about those, it began with the IASC. Since then, we call it the IASB. As Bob pointed out, we're going to talk about them as the IFRS, the International Financial Reporting Standards. Now, both the FASB and the IASB have long worked to converge these, to bring them to, to make these accounting standards similar. The SEC in the U.S. has long been supportive of this. And effectively, what we were looking at the last few decades, was that if you were a foreign company, wanted to sell securities in the U.S., you had a choice. You could use U.S. GAAP to prepare your financial statements, or you could use home country GAAP, which now sort of to a large extent for many companies would be international accounting standards, at least since 2005. But the point is that you were able to use home country accounting standards, prepare your financial statements, and then you'd have to reconcile them to U.S. GAAP. And those reconciliations are in the Form 20F. There were items 17 and 18. And from the perspective of many of us financial analysts, it's certainly, for many years, those reconciliations have been very, very important information. We've used them, we've analyzed them, we've done research with them, trying to understand better the financial statements developed by and provided by foreign companies. Because, it's obviously when you're working on this as an analyst, as an investor, you want to look at different companies that are in the same industry, the same space, so to speak, and compare them. So the reconciliations were very helpful. And as I said, the SEC has long been supportive of the convergence project that the FASB and the IASB have been working on. Now, in April 2005, the SEC staff issued a roadmap which detailed the milestones, the different steps that would have to be achieved in order to get to a point where that reconciliation would be eliminated. And one of the reasons for that elimination, of course, or the desire and then the need to eliminate that, is that so that people wouldn't have to keep, in a sense, two sets of books. They wouldn't have to, the foreign companies wouldn't have to effectively keep in mind what the U.S. GAAP was, make sure they understood what the differences were, and then correctly identify the major differences, show the differences, and then write about them, disclose the issues involved. Now, what the SEC therefore had said, that here are some of the things that we'll need to do before we can eliminate this reconciliation. So, if you look at what that roadmap does, and by the way, if you want to take a look at that roadmap and read some more about it, you can certainly find it on the SEC website, sec.gov. In particular, I would direct you to a speech given by the then chief accountant of the SEC in April 2005, and in the appendix to that speech, you'll see the detailed roadmap. And the things that I really found very important in that roadmap, the SEC staff pointed out that there would have to be a detailed analysis of the faithfulness and the consistency from three perspectives: the use of international accounting standards, the interpretation, in other words, how they had to be applied, and then the enforcement of IFRS in the financial statements. And clearly these things mattered because of the way people in the past had applied international accounting standards. For those of you who are really interested in this, you may want to take a look at David Cairns' book on the application of international accounting standards, where he showed that prior to the requirement, the 2005 requirement that I'll talk about, prior to that, it really wasn't as well done as one would like. In other words, companies used to apply some standards that were international accounting standards and others which were home country accounting standards. In fact, I believe, an appropriate way to say that would have been in their following their financial statements, most companies should have said that these financial statements are prepared in accordance with international accounting standards, except where home country GAAP is better, because that's what they were doing. So given that, obviously it's critical that the SEC was going to look at this, and they were interested in ensuring the consistency of application, interpretation, and enforcement of IFRS. And they expected to complete this evaluation during the 2007 through 2009 period. The SEC staff said they would also monitor the effectiveness, the continued progress of the convergence project, the IASB-FASB convergence project. And at that point, in the 2005 document, the SEC staff in that roadmap said that somewhere around 2009, maybe sooner, they would decide whether and when it would be possible or would make sense to recommend the elimination of that reconciliation requirement. In other words, actually effectively allow foreign companies to register and sell securities in the U.S. Without having to reconcile their financial statements, the stockholders' equity and the net income in particular, in other words, to U.S. GAAP. Now, as I pointed out earlier, in 2005, beginning in 2005, foreign companies, particularly European companies, started using and applying IFRS. I've given you here on the slide that you see on your computers the regulation that was issued by the European Parliament Council Union that was issued July 19th, 2002, which talked about and required that beginning in 2005, all listed European Union companies, including banks and insurance companies, should prepare their consolidated financial statements using IFRS. Now, at the moment, since that 2005 requirement and the 2002 decree, since then, a large number of companies have actually been saying that they prepare their financial statements using international accounting standards. As I've pointed out over here, there's probably somewhere in the neighborhood of 100 countries that require those financial statements to be prepared in the use, or maybe they, if they don't require it, they at least permit the use of IFRS. And that number of countries is certainly on the. Now, in keeping with the SEC's desire to look at this, to evaluate the need for this, the SEC has taken a few other steps as well. In March 2005, the SEC extended the compliance dates for management's report on internal control over financial reporting. So foreign companies were given additional time to do that. In April 2005, the SEC first-time IFRS adopters to provide 2 years of data rather than the normal 3 years of data in the financial statements. So for some time, we've had that issue where companies have been able to give us less information than effectively most U.S. companies would have to provide in their filings with the SEC. Now, in December 2007, the SEC announced its decision to accept foreign private issuers financial statements that were prepared in accordance with IFRS. Now, please notice that there's a very important phrase here. The SEC decided to accept financial statements prepared in accordance with IFRS as issued by the IASB. That's the operative term, that it ought to be as issued by the IASB. The SEC has taken pains to point out that they intend that to refer to the authoritative text of the IFRS that's published in the English language as provided by the IASB. Now, the reason for this and the reason why it's important, certainly from my perspective as an analyst, as a user of financial statements, as an investor, is that unfortunately there are companies today, I believe, that say they prepare financial statements in accordance with the IFRS, but they may not be. They may be slightly different versions. And it's not clear that everybody is doing that. Okay. Now, having said that, please remember that the SEC is also telling us that the decision to accept the foreign private issuers financial statements prepared in accordance with the IASB pronouncements does not extend to filings that are prepared under other accounting standards. It also does not apply to financial statements that are filed under standards that are not in full compliance with IFRS as issued by the IASB. So that point that I had made earlier, that it's absolutely critical that we understand whether the financial statements are consistently in accord with the IFRS. That's very important. So at the moment, the SEC is not permitting other accounting standards to be used. And to facilitate the implementation of this December 2007 decision, please keep in mind that the SEC has also adopted amendments to Form 20F requirements, as well as made various conforming changes and amendments to Regulation SX, I should say S-X, and both the Securities Act and the Securities Exchange Act. All of those conforming changes, at least the auditors in the group ought to be very clear about. So please take a look at the December 2007 announcement by the SEC. Now, please keep in mind that this amendment applies to financial statements of foreign private issuers for years ending after November 15, 2007, as well as interim periods within those years that are contained in filings that are made after the 4th of March, which is the effective date of this pronouncement. Now, for first-time adopters of IFRS, this amendment applies after the effective date. Okay. Now, the SEC, in its decision, its December 2007 decision, also made some comments and provided some additional information about comments that they had received on the proposal to eliminate the reconciliation. And the SEC staff tells us that the comments received were generally favorable, and the elimination of the reconciliation was viewed as a recognition of the success, the quality of the convergent process. The majority of these positive comments were received from preparers, they were received from law firms, auditors, but they were also, to a large extent, from commentary that was received from foreign respondents as well. Now, on the other hand, institutional investors and financial analysts provided mixed comments. A very important concern that was expressed was that although the IFRS may someday, please note that in the future these investors and analysts expect the IFRS to potentially provide high-quality international standards, it may be too soon to eliminate the reconciliation. I will tell you, in the interest of full disclosure, that I certainly believe that. And I have been on record saying that when I served on the Committee of Financial Analysts on behalf of the CFA Institute. And I certainly continue to believe this today. Please also keep in mind some of the other comments that were received. And this is particularly, of course, reflects my bent because of the way I see the differences between international accounting standards and U.S. GAAP. I believe, and a lot of the people commenting on it, the institutional investors and the analysts believed, that there was considerable value to both the quantitative and the qualitative content of the reconciliations. So losing that is a problem. They also said that they felt the convergence process, is really not sufficiently complete. They're concerned about that, and I do agree that it's not yet complete. But I believe that maybe the most important drawback is there's a lack of focus on disclosure requirements. But that lack of focus, for example, has long been present in standard setting. It is certainly something that's present in the convergence process. I think that there are accounting standards where the two boards have said they've converged, and yet I don't see the disclosure requirements converging as clearly and as effectively as one would like. Please keep in mind that not only is there this absence of focus, but at the same time I strongly believe that enforcement of disclosures is seriously lacking. I also believe, and these comments had also made this point very clear, that the reconciliation requirement promoted financial statement quality. So in other words, it promoted the quality of the information content. And the question these people are asking, and that I would also ask, is the elimination of the reconciliation going to have a negative impact on the quality of financial statements? Some other concerns that people had relate to governance at the IASB, and then also the future funding of the IASC Foundation. The IASC Foundation is the entity that is, in a sense, would be similar to the bodies here, the FAF, et cetera, in the U.S. So the point is that some very important issues remain sort of unanswered, unclear, and the question is whether the elimination has come too soon.
Tony, if I can interrupt for a minute here, I want to remind our audience that please feel free to ask Tony a question. You have on your console the Ask a Question box. Type a question there. I'm reading them as they come in, and Tony will answer as many as possible at the conclusion of his prepared remarks. So please keep the questions coming. Tony, we do have one question here. What about the proposal to allow U.S. companies to use IFRS? Is that a possibility?
That's a very good point. Last year, the SEC did start talking about that, and obviously, that's a step that they would have to take because, what's happening right now is we're looking at the fact that the reconciliation requirement has been eliminated. So obviously, what the U.S. companies would ask is, why not level the playing field? Why can't we use international accounting standards, therefore IFRS, to prepare financial statements? And, you could, as Bob Hers, the chairman of the FASB, has pointed out, take a look. There's, more than 100 countries, using international accounting standards. And we've got, one, in a sense, to a large extent, the U.S. that uses U.S. GAAP. There are other countries to a small extent as well, but the point is that we've got one major country over here. And I won't get into any kind of a discussion about, whether we should look at market caps and this and that or relative importance of the economies or anything like that, because I do believe that at some point it would make sense to have a single set of accounting standards. The question really is, are we at a disadvantage? And that's what people here are asking. And that's why the issue, and that's why the movement towards allowing U.S. companies to do the same thing. Now, the question, that I'm going to raise here and emphasize a little bit as we go forward is, do we really have the enforcement mechanism in place? Do we know, are the auditors and preparers ready to do this? How many people are really as comfortable, as well-versed with international accounting standards as, for example, at least in the U.S., they would be with U.S. GAAP. And I think the same question has to be asked about foreign countries as well. In how many foreign countries are people really comfortable with international accounting standards? I mean, what about the education process? What about the enforcement requirements? So those are some of the questions. So your question is a very good one. The movement has begun. The question that I'm trying to get some information out to you so you can think about it is whether the time is right for that. Now, let's take a look at, let me make a few comments about IFRS and U.S. GAAP. Now, as I've noted before, the FASB and the IASB have made significant improvements. The Convergence Project has, I think, had some notable success. It has reduced differences. And I think that reduction in differences may also have started to become apparent in the 20F reconciliations. But please keep in mind, the 20F reconciliations, much of the analysis, much of the discussion focused on the differences. Very few people spent as much time as I think they should have on the differences in disclosures. And that, again, is a theme that, of course, I would come back to, and you've heard that from me. So what's happening with IFRS and U.S. GAAP? As I point out here, there are major reporting standards that are now quite similar. For example, there's tremendous progress in acquisition accounting. The recently issued 141R, and, of course, the accounting changes, FAS 154, IAS 8, are quite similar. But again, let me remind you, there are still differences, and they're substantive. In fact, even if you look at 154 and IAS 8, there are some very, very important distinctions that remain between the two. I would say that 154 asks for certain kinds of information that you're not going to get in IAS 8. And I think that makes a difference. That's information that I would like to have, user of financial statements. So the point is that there are still major inconsistencies. There is substantive reporting disclosure requirement differences. And despite this extensive collaboration, I think there are differences that remain. And I'm going beyond some of the shortcomings in both U.S. standards and IFRS. There are, both of them. I mean, there are some places where one could say the IFRS may have a better standard, others where the U.S. GAAP is better. But the point is that the inconsistencies remain, and absent an elimination requirement, it's unclear how people are going to get this information. Then, as I said, the major concerns that remain, let's take a look. Probably the most important one is that the IFRS have not really been applied for very long. And at this point, there isn't enough data, there isn't enough research that's been done, which allows anyone to say whether the IFRS are actually going to be able to provide both either adequate or high-quality information. And please keep in mind the point I'd made earlier. I don't think it's possible to say right now whether they're being applied consistently. And if that's not the case, then how do we know? How are we going to be able to tell that there's high-quality information? I think insufficient attention has been paid to disclosure requirements. It's possible this is a culture issue. We've had the SEC around for much longer. We've had the market providing capital for much longer than it has elsewhere. It's possible that these kinds of things make a difference. I think auditing and enforcement of disclosure requirements remains significant and seriously inadequate. Just take a look at the accounting for stock options. Look at securitizations. We still have very substantive differences in how we account for securitizations. The investments in subprime mortgages, investments in structured investment vehicles are some of the examples that you can think about that suggest that there are significant problems in the areas of reporting, disclosure, auditing, and enforcement. I mean, think about, for example, UBS's assertion the other day about issues with respect to pricing. So the application of fair value accounting is something that's very, very difficult at the moment. Some of the other issues, I don't believe that sufficient attention has yet been paid to corporate governance issues. I think more progress is needed on, developing an international equivalent of the U.S. MD&A and an enforcement agency such as the U.S. SEC. Because if we're going to have everyone using IFRS, we certainly need an enforcement agency that's going to be able to tell us whether the financial statements follow GAAP and whether they're giving us useful and correct information. I think there are some significant philosophical and cultural differences with respect to financial reporting of derivatives, fair value accounting, and consolidations, for example. And I think these are very critical elements in financial statements these days. You look at large financial institutions, large multinational companies, and if you don't have a good sense of how and what you're going to find with respect to derivatives, fair value, with respect to consolidation, that's going to make it much more difficult to rely on the financial statements. Now, having said that about these financial statements, about some general differences, I'd like to spend just a few moments, and this is why I said at the start of my remarks that I'm only going to be barely going to be able to introduce you to the differences. So let's take a look at some issues in revenue recognition. Now, clearly, U.S. GAAP and IFRS are in essence the same as far as basic revenue recognition goes. The general guiding principle is the earnings process and the realization of the asset result. To that extent, we're similar. Now, there is, however, a very important difference. Revenue recognition under IFRS is provided in terms of broad principles, and there's very little implementation guidance. And for some very specific industries that you see the accounting standards in the IFRS, for example, IAS 11 on construction contracts. You have revenue recognition guidance, but if you look at U.S. GAAP, there's an extraordinary, one could say, amount of implementation guidance that you don't have at the international level. So a comprehensive plan for developing implementation guidance, I think, would be critical to the use of IFRS. Some other points that I think that I should make. There's a lot of implementation guidance in the U.S. The ACSEC and the EITF have been very active standard setters. And the SEC staff has also provided a lot of implementation guidance. For example, obviously everybody knows about SAB 104. Now, of course, what's happened is that because of all these different sources of accounting standards, I think the FASB once identified there are probably more than 100 different documents that deal with revenue recognition in the U.S. One of the slides that you'll see towards the end of this deck that I've given you, you'll find I've listed on one slide just about all the international accounting guidance on revenue recognition, just to give you a sense of the difference between the two. Now, of course, that's why there's a widely held belief that the international accounting standards are principles-based and U.S. GAAP is rules-based. And that, to some extent, that's true. But maybe the correct place to be is a few more principles for the U.S. standards and a little bit more implementation guidance at the international level, and I think we might get to a usable or a worthwhile medium. Now, the FASB undertook a comparison of U.S. and international accounting standards a few years ago in the late 1990s. I've referenced the document. You might want to take a look at this book that was published. Take a look at the second volume because the first volume had only part of the analysis, and the second volume gives you all of it. Now, it's very instructive to note that the FASB did not include a comparison of U.S. GAAP on revenue recognition with IAS 18, and the rationale they provided was simply that there was just there were far too many sources of U.S. GAAP, and you have this. Now, the FASB comparison project noted two things that I'd like to remind you of, and that is, that so much U.S. guidance that in the event that guidance did not exist and all we had was broad and general principles like IAS 18, the FASB staff noted that it's arguable whether various preparers and auditors would apply the same accounting for those transactions. In other words, a similar transaction at two different companies or even within the same company over a period of time might be interpreted and analyzed evaluated differently. And I would suggest that this contention actually continues to be applicable with respect to revenue recognition today. Now, a couple of the specific issues noted by the FASB staff. For example, one of the points is that the International Accounting Standards use the term probable, but they do not define it. And because they do not define it, which is perfectly fine in keeping with the broad principle, and maybe one could argue that probable is a term that most of us should understand. But here we are, it's clearly, as we know in the U.S., probable is not understood the same by two different people. It's possible to have differences of opinion. In that sense, auditors and preparers would have different interpretations and therefore would have different reporting for the same transaction or similar transactions. Another point that they noted was that in IAS 18, paragraph 26, says that revenue is limited to recoverable expenses when the outcome of service transactions cannot be reliably estimated. Now, if you look at that, although we do not have an accounting standard for service transactions, we certainly have the 1978 invitation to comment. We've got Staff Accounting Bulletin 104 that provides guidance on how to apply the basic revenue recognition concepts to service transactions. So in that sense, we do have implementation guidance. And that would give us a different answer than the IAS 18 paragraph 26 would. Another point that I wanted to make over here was that there are quite a few other differences. For example, if we compare U.S. GAAP to IAS 11, in other words, compare the contract accounting requirements, U.S. GAAP gives significant guidance for federal government contracts. Auditors, I think, differ on the application of the zero gross margin method. There are differences of opinion with respect to the accounting for incentives and penalties. So you could argue that the completed contract method is actually not permitted by International Accounting Standards, by IAS 11. There are still significant differences with respect to combination and segregation of contracts. So even where we actually have an accounting standard to compare in both, it's very, very difficult to say that they're similar. Software revenue recognition, very important issue from the perspective of most of the people here who are listening in on this webcast. Software revenue recognition in the U.S. has SOP 97-2, 98-9, 76 technical practice aids. A significant amount of work has gone into this. That does not exist at the international level. We do not have those kinds of things. And remember, those kinds of standards. Several studies, many of them by the SEC, have repeatedly shown that revenue recognition is one of the major reasons why companies make statements. And software revenue recognition is certainly a very big part of that. So from that perspective, not having guidance on one side, having it in the U.S. and then saying that all companies will be permitted to use international financial reporting standards raises the question as to what is it that people are going to do with respect to 97-2 and 98-9, or in other words, software revenue recognition. And I understand that one possibility is that until the ISB project on revenue recognition is completed, software companies might use 97-2, 98-9. But remember, the point is that implementation guidance does not exist in the IFRS. So the question is, to what extent do they use that if they start applying 97-2 and 98-9? But that's not the only issue that matters with respect to these. I think one of the most important distinctions would be how one responds to, evaluates the interaction between 97-2 and multiple element accounting requirements. You see, many of us, many companies today insist on their focus is on selling solutions. They're not limiting themselves to a single product or a service. If they do that, then they are going to face, under certain circumstances, the question of whether 97-2 applies or 0021 does. The classic example is when there's customization of software, because then you end up with 81-1 and non-81-1 deliverables. So that's a very important distinction between the two sets of accounting standards. There are very, very significant differences, and in fact, to a large extent, VSOE of fair value, subscription accounting, and revenue recognition when there's a single unit of accounting but multiple payment streams, post-contract support. The accounting for these standards, these issues, under IFRS is certainly unclear because there isn't guidance on these issues. So what do you think companies are doing? Having recourse to disclosures doesn't do anything for you because the disclosures are not the same. And if the disclosure requirements are not the same, how can the enforcement be similar? What is the SEC going to do with respect to that enforcement once they decide that all companies should be permitted to use IFRS? So there are some very, very important issues that we need to keep in mind and think about with respect to this issue of when we all can use IFRS. Bob, those are my comments.
Well, my head is spinning with your presentation and all the questions that have come in. But I want to remind people that many of the questions have to do with copies of the slides or CPE credits. I've given that information out beforehand. I'll give it at the end of the webcast as well. So please hold those kind of questions. So, Tony, before your last few slides, there were, as you would expect, lots of questions about the similarities and differences between IFRS and U.S. Related to VSOE and 97-2, and then you seem to address most of those. But I still think there are other questions with respect to fair value and in IFRS versus U.S. GAAP. Anything else you think you should add for further clarification around VSOE?
Well, what I would say, what I should say really is that, U.S. GAAP 97-2, 98-9 tell you that VSOE is required. They give you the residual method. You look at EITF 0021, you've got the need for objective and reliable evidence of the fair value. Now, one could say that these are actually principles, and there really isn't that much implementation guidance as to how one should measure VSOE of fair value. Practice seems to have coalesced around sort of the bell curve analysis that most people use. Now, the problem is that there isn't anything like that. Neither does the principle. The principle doesn't exist, that of VSOE in IFRS. There are comments about fair value, and if you think that there are sections in the IFRS that deal with multiple element or sort of the similar things or issues similar to 0021. But there's no guidance there. So it's not clear what people are going to do. And you can, most of us who work in software revenue recognition these days are aware of the problems with it. Companies know it, how difficult it is, how much work goes into it. And we also know of cases where companies have basically said it's very, very difficult to do. The NEC example comes to mind. It's a fairly recent announcement from them. So the point is that we do have principles here that the implementation guidance, which is lacking in the U.S., is a very, very important sort of indicator of what we will be looking at if all of us start using IFRS.
And with respect, a good follow-up question, I think, is with respect to the convergence project. Which way is it? Which way do you think it'll head? Do you think it'll move towards more of software revenue recognition as we know it into IFRS, or U.S. GAAP doing away with some of the guidelines that we already have?
Well, it's it's very difficult to say, but at the moment I would say that there certainly is a lot of work that's going into thinking about, whether the SOE of fair value and those kinds of principles are the appropriate ones. And there people are actually asking some very, very good questions. I think the project, the FASB Revenue Recognition Project, is a very good one. I think it has the potential for resolving some of this, but the timing is very difficult, and I certainly don't see it being done. I think it would be very difficult to have it done in the next year or two, which seems to be the time frame for adopting IFRS. So, one way to look at it is that maybe, one simple solution would be to say, okay, you can use IFRS, but where you don't have GAAP, then you use the existing GAAP from the U.S., which would leave us at the same place. But if that doesn't happen, then there's a question of whether U.S. software companies would be at a disadvantage relative to international companies for that 1 or 2 or 3 year period before we get to some sort of an agreement as to what we should do. But it's hard to say.
So we have some enforcement questions, Tony, as you might imagine, and one being that if the U.S. adopts IFRS, who do you see will ultimately have the overriding enforcement, the FCC or IASB?
Well, given how popular the U.S. is in so many different things, it's hard to see that the FCC will end up be enforcing it outside, which then brings up the question, do we have two different levels of enforcement? At the moment, there isn't a good answer to that. There's a lot of work being done, I believe, or at least that's what I read. I don't see how that's going to work because the SEC mechanism that we have in the U.S. is a very different one from the rest of the world. And grafting that onto the rest of the world isn't all that straightforward. So that's a very, very big if with respect to this. And, a colleague of mine has recently said that, what do we do? Let's say we decide to switch to international accounting standards, but then we decide 2 years down the road that either because of enforcement or because of the way the accounting standards are applied, it doesn't work for us. What are we going to do? 2 years later, switch back? And those are the kinds of questions that would be useful if people actually had a good, transparent debate about it.
And this next question, I think, dovetails into that, is that, for the people who are living this, doing financial reporting for public companies that have practiced GAAP, their whole professional life, and still learn something new every day, it creates certain hill to climb in terms of learning a whole new group of standards when you have to report every 90 days. Any advice on what should someone do in terms of coming up to speed?
Well, I think that the best advice I can think of is get started as soon as you can.
Well, they're on the webcast, so that's a good sign.
Yes, that is.
What do they do after? What do they do after?
Well, I think that what you're going to have to do is be very selective and be very careful about where you go to learn this stuff. Because there are certainly going to be a lot of people offering to teach it to you. And, the question is, how do you start? Do you start by looking at it saying, okay, I'm going to focus on the differences? You see, because I already know U.S. GAAP. So should I go to a place which offers to teach me the differences? Or should I start with the accounting, the IAS themselves, the IFRS? And those choices, those decisions are going to have to be made very carefully. I think it's going to be very, very critical to get started. There will be good programs out there. And, you can certainly come to mind. But the point is that people who have a fair amount of experience with U.S. GAAP are still going to need to rethink the way this works because there's a fundamental difference between international standards and the way U.S. GAAP is done or has been developed in the past and the kind of guidance that we have today. So there are huge differences. And I think it's going to be very critical. What people are going to have to do, I believe, is not only, this is from the perspective, say, of auditors, they have to understand the differences, and then they have to start thinking about how those differences need to be translated into audit procedures. Because I believe, from the years that I've been talking to auditors and preparers outside this country, I think there are some incredibly fundamental differences between the way they do their work and the way we do it over here. So, for foreign companies, looking at those, trying to understand how that works, all of that is going to require, it's not the same thing as learning U.S. GAAP. It's more complex.
Okay, well, thank you very much, Tony. We are up against the clock here. I appreciate your comments, very insightful. I think it's clear that, and we'll make it clear to our people in marketing that we'll need a series on this and continue this discussion because as things continue to evolve here, and as always, you'll play a critical role in educating our customers and the audience at large. So we very much appreciate your time. It's very topical, as evidenced by all the attendees and evidenced by the many questions. I thank the audience for spending time with us today. We appreciate and value your time, and also thank you for the many questions. I'm sorry we couldn't get to all of them. We do make an attempt to follow up afterwards with as many as we can. And I certainly encourage people to continue to visit our websites, SOFTRAX.com and RevenueRecognition.com, to check out and check your email for future events. And please remember, as you look at your screen now, there are lots of questions people joined in process. In order to get the copy of the slides, please use this URL and make sure your pop-up blockers don't get in the way. And this will allow you to get copies of the slides, the link for the recording, CPE credits, which many of you want, and 10 of you will get Tony's book on revenue recognition. So thank you very much, Tony. We appreciate it, and thank you very much for everyone who joined today.
Thank you, Bob.